How do correlations change with implied volatility? Let's take a look. A popular topic is brought up in low IV markets like we have now, is that the tendencies for individual stocks and even sectors to become less correlated to the market. You're seeing that right now. You've got these crazy divergences like, we've talked about these AI stocks left and right, but then you have other stocks that just haven't participated at all. This makes sense because volatility is low and the market just goes wherever they think. It's kind of like wherever you think there's something there, everything charges in that direction. So today we will reveal the specific correlation values that we observe depending on different levels of market volatility at extreme lows versus extreme highs and everything in the middle. Let's take a look. ETFs, 20 sector ETFs since 2015. Observe the average correlations between the SPY and each of the sector ETFs when the implied volatility rank in SPY was above 50, between 20 and 50, and below 20. Where's the SPY IVR right now?
Ooh, good question. It's low. SPY
IV rank.
13 and change.
There you go.
Implied volatility, 13 area. That's bad.
All the risk right now. NASDAQ down 20, Russell up 3. Somebody better call the central bank. Yeah. Over time, the average correlation between the SPY and a sector ETF is about 0.6. There is a price relationship most of the time, but there are some days they're independent of each other. The year in which the correlation was highest or lowest was directly proportional to the volatility environment. It's a little confusing here, but you can see these are the 20 sector ETFs from 2015 on. So the average correlation between the SPY and the sector ETFs since 2015, the long-term average is 0.6. The long-term average implied volatility is 18. The year with the highest average correlation was 2022, and the year with the lowest correlation was 2017, 0.44. Do you remember what 2017 was like?
2017 was death.
Death. We did nothing.
It was like walking in Death Valley looking for water.
We ground higher, tortured. We went tortured higher.
We may even grinded higher, but yes.
Anyway, 2017, we didn't do anything. The correlation was 0.44. And 2022, we finally had a down move. Post meme stock, after we had the huge rally after the pandemic, we jumped all the way up to 0.7. Implied volatility there was 26, average for the year. Implied volatility in 2017 is 11. Where does implied volatility look like it is right now? Closer to 2017.
Sure.
That's for sure. Low IV environments saw semi-strong correlations, but high IV environments saw much stronger correlations. The correlation difference between 0.55 and 0.7 is significant. It's like comparing the correlations between the SPY and XOP or the SPY and IWM. So again, we want to show things up here. IVR less than 20 where we are right now, the correlation super low. IVR between 20 and 50, 0.65, and IVR greater than 50, 0.7. Just showing you that when and if markets ever do go down, you are going to have very high correlations. Right now, you got nothing, honey.
So with implied volatility being so low and the market having a little bit of divergence between the Russell and the Dow, from this study, that would seem relatively normal, right? Because you don't have that one-to-one necessary correlation with implied volatility.
Right now, a lot of the market, kind of the weirdness in the AI stocks, a lot of the weirdness of the market can easily be explained by...
There's only a few stocks that are really lifting this market to all-time highs.
Yeah, it's nothing. Handful of AI stocks, which make no sense to me. I mean, I kind of think it's all got to be wrapped around this, what's happening right now over this rebalancing or something like that. I have no idea. Besides observing a higher correlation in high IVR, we also see a higher correlation when IVRs drop fast. So when prices move fast, up or down, everything tends to move together. This time we took a look at the same thing when everything just moves, but they don't go, it's just cyclical. They're just jumping around. So when IVR went from below 20 to over 50, everything went to 0.7. That's just this huge correlation. When IVR went from above 50 to under 20, it dropped a little tiny bit, and the long-term average is 0.6.
Which is, when you asked me the question to begin with, this is the way I thought it would be.
The bottom line here is that when implied volatility is high and implied volatility rank is high, the correlations are high. Everything goes down together. Mm-hmm. It's kind of a warning. It's a red flag. It's a warning thing. The other things, when other things are happening, the market's just going up and volatility is contracting and IVR is low. Certain things just move on their own, have no rhyme or reason to anything else. And that's kind of what you're seeing right now. So as implied volatility is measured by IVR changed quickly up or down, we noticed an increase in the correlations between individual sectors and the overall market. Correlations were weakest in times of steady and low implied volatility. Make sure to stay small in periods of low correlation. because just like volatility, it can only strengthen from here.
Is that a warning?
I think it is. I think it is.
Surgeon General type of thing, or is it like a real warning, like a whoop, whoop warning?
I'm just saying.